So I am 22 years old, and I have $20K in debt, and I am currently paying off 3 very predatory payday loans that are eating me alive inside. I'm sick and tired of being sick and tired.
Imagine a $500 loan turning into a debt of over $3,300, or paying $10,560 in interest without even making a dent in the principal. Well, this is just the reality for thousands of folks that get caught up in the treacherous web of payday loans. A world in which one missed payment can have you feeling like you've entered the sunken place with no cotton to put in your ears. Payday loans seem like and can actually be a quick fix when you find yourself in a bind and have no other means of acquiring funds. You need cash fast, and these companies can deliver it to you quickly with no credit check and minimal questions asked. But here's the catch. The interest rates on these loans are so high that even Cheech and Chong and Snoop Dogg can't touch them.
Jennifer Williams, a Mississippi mother, was having trouble covering her expenses on a school teacher's salary. So she turned to a so-called payday lender.
I started with $200, and then when it was time for me to rewrite, I increased it to $400, and that was the start of my payday lender journey.
That one loan turned into how many loans?
At the end, I had a total of 9.
Payday lenders provide customers like Williams with short-term, small-dollar loans. But unlike traditional banks, they don't require credit checks or consider whether a borrower can reasonably repay loans. The catch? Shockingly high interest rates, often as much as 400%.
Here's how they work. Payday loans usually carry finance fees of anywhere from $10 to $30 for every $100 borrowed. So say you get a loan for $500 and they charge you a $15 finance fee. At the end of your loan term, which is usually 2 weeks, you'll owe $575, which translates to a 391% APR, or annual percentage rate. Now, because the reason you've taken out this loan in the first place was because you were strapped for cash, there's a pretty good chance that you may not have that $575 to pay it back in 2 weeks.
All this opportunity to do a payday loan. It was a quick and easy way to get some money to pay the bills.
Mike handed over his bank account information and got money fast.
It was instant gratification. The bill was paid and I felt great.
But when it came time to pay back the loan, Mike didn't have the money.
I took out another loan to pay that off, and then another loan to pay that off, and then it all just downward spiraled from there.
So it was kind of like a snowball effect.
Exactly.
The interest, finance charges, and fees, it all added up. Mike ended up $12,000 in debt.
But because they're so considerate and understanding, in states where rollover loans are allowed, the good old loan company will let you pay the fees only and roll over the principal into another loan. However, as you already know, this new loan also comes with additional fees. Oh yeah, and don't forget, you still owe the principal amount from the last loan.
Paula's lender charges $20 for every $100 borrowed over a 14-day term. That's an annual percentage rate of around 500%.
After another lackluster couple of weeks at work, Paula unfortunately only has $150 left over, far from the $600 she now owes. When the lender tries to automatically deduct it from her account, it triggers a $35 overdraft fee from her bank. If she pays the $100 of interest on the loan, the lender will graciously allow her to roll over the debt for another 2 weeks. Paula has already paid $135 in fees and interest, and she's not 1 inch closer to paying back the loan.
In addition to the high interest rates, a lender is able to charge late fees, rollover fees, returned payment fees, prepaid debit card fees, and even some require you to set up autopay, but then continue to withdraw funds from your bank account well after the loan is paid off. Now let's talk about Texas. The Lone Star State is a hotbed for payday loans with an average interest rate of a ridiculously high 664%. To put that into perspective for you, the APR for cash advances on most credit cards is around 28%, which suddenly looks like an amazing deal.
this be legal?
It's a question I get asked all the time.
Ann Bedore works on consumer protection issues for Texas Appleseed and the Texas Fair Lending Alliance.
People think, don't we have rate caps? Don't we have usury laws? But these businesses have kind of seeped through a crack in the system.
Here's how that crack works. Under Texas law, banks cannot charge more than 10% interest, but so-called payday lenders aren't actually lenders. They're brokers known as credit access businesses who arrange the loans, and there is no cap on the fees they charge.
And because Texas has extremely lax laws, on the face of it, nothing they're doing breaks the law here.
Elsewhere, the exorbitant interest rates are banned. 16 other states and Washington, D.C. have prohibited high-cost short-term loans. But in Austin, efforts to rein in so-called predatory loans have repeatedly failed, leaving Texans to protect themselves.
And it's not just the high interest rates and debt traps that you need to worry about. There's also predatory lenders and scammers out there, ready to exploit your financial situation. Predatory lenders often reel you in with the promise of quick cash. They set up shop in neighborhoods where they know people are desperate. Their loans come with interest rates that would make your head spin, like those in Texas. What starts as a small loan quickly turns into a mountain of debt. But it's not just the interest rates. These lenders pack their contracts with hidden fees. You think you're just borrowing a few $100s, but suddenly you're paying for processing, late fees, and more. And their tactics can be aggressive. They lure you in with flashy ads promising easy money. But behind the facade, there's a catch. They're not transparent about the terms of their loans. They might not even be licensed, operating in the shadows, away from legal scrutiny. These lenders target the most vulnerable. They go after people who need money fast and don't have time to read the fine print. They prey on low-income neighborhoods and people with poor credit scores.
Just made it to Milwaukee's north side, and as you guys can see driving around here, it's in a pretty rough state with 41% of the people here being in poverty and one of the 4 houses you're seeing being completely abandoned. And when you check for payday loan spots close by, you guys can see they're literally like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, all within like a 3-mile radius. Payday loan locations are usually found in the poorest areas of a city, and I mean, it only makes sense. You gotta stay as close as possible to your customer base.
They use pressure tactics, rushing you to sign before you understand what you're getting into. And the loan terms, well, they're often designed to keep you in debt, with short repayment periods and balloon payments that are impossible to meet.
In assisting clients, I also encountered a few clients, specifically an elder gentleman that I've been working with for the last 5 years. Even talking to the clients, all he would say is, yes, they gave me $255, which is the maximum, and I had to pay $300 back.
Now let's talk about the scams in this industry. There's the identity theft scam, where lenders steal your personal information to take out loans in your name. Then there's the advance fee loan scam. They promise you a loan, but first, you need to pay a fee. You pay, but then the loan never comes. Debt consolidation scams are also common. Some lenders will offer to consolidate your loans into one payment. It sounds good, but they might charge you an even higher interest rate and extend your debt, trapping you even deeper.
Scammers are stealing personal information by pretending to be debt collectors.
So as a consumer, what we would tell you to be on the lookout for is unsolicited communication. So you receive a text or an email or phone call saying you're eligible for this money. That should be a red flag. But also any loans that require money up front, advance fee loans, should also cause a red flag to go up as well.
And these scams are growing day by day because there are a lot of loopholes in legal areas. For instance, while New York and Oregon have strict regulations, Texas is a different story. It's a place where predatory practices thrive, largely due to the state's legal framework. The state doesn't cap interest rates, allowing lenders to charge exorbitant fees. Payday loans are usually due within 2 weeks, a period too short for many borrowers to repay, especially those already struggling financially. And when they can't pay on time, the option to roll over the loan only adds more fees, trapping them in a cycle of debt. It's not just Texas. Other states with lax regulations also provide fertile ground for predatory lenders. This creates a risky environment, especially for low-income communities and minorities, who are often the ones who fall prey to these debt traps.
They want you to not pay that loan. The whole object of the game is to get those folks in there who they know can't afford to repay, because that's where the money is. There's no money in you repaying. Where I make money is that you have to keep rolling over that loan over and over and over again and never get out of the cycle.
The lure of payday loans often leads not just to financial ruin, but also to deep psychological and physical distress. The cycle of debt can also lead to a deep sense of hopelessness.
Scared as an individual, what am I going to do? Am I going to lose everything that I've worked so hard for?
I just felt beat down. I just thought I was on a merry-go-round that I was never going to get off.
Being a servant to a lender, that's what I felt like.
It's an addiction, because then you get in this vicious cycle where you really don't have the money to pay them back.
There's very little difference between loan sharks and payday loan lenders, payday advance lenders. It's just a matter of the way they enforce it. They break your lives apart instead of your knees.
By understanding the warning signs of predatory lending, you can avoid getting pulled into a situation that spirals out of control. One major red flag is exorbitant interest rates. Be cautious of any lender offering rates above 30% APR. Hidden fees are another danger sign. These can be cleverly disguised in loan agreements with terms like processing fees or origination charges that inflate the cost of the loan significantly. If you find yourself trapped in a predatory loan, take action. Report the lender to the Consumer Financial Protection Bureau, CFPB, and your state attorney's office. This not only helps you, but also aids in protecting others. Seeking legal advice can also be beneficial. A lawyer specializing in consumer protection can provide advice on your rights and the best course of action.